we start with another record day on Wall Street. The S&P 500 and Dow closing at all-time highs for the fifth straight day. The S&P now officially double its pandemic lows. The moves coming as Fed officials grow increasingly supportive of starting to wind down the central bank bond purchase program. Let's get the latest with Steve LIESMAN, who just spoke with Boston Fed President Eric Rosengren. Steve, very fresh comments. What did Mr. Rosengren have to say?
He basically agreed with the general idea about the Federal Reserve's Market Committee looking to really coalescing around a plan to announce it will taper its asset purchases in September and begin reducing them a month or so after Rosengren was a little more comfortable with waiting a little bit longer to start. So here's a new potential taper timeline from our reporting, Courtney. A taper announcement happening in September. Last month, by the way, market consensus had been centered around November or December. The taper beginning in October or November. That depends on how much advance notice the Fed feels it needs to give markets. And then a taper that lasts 8 to 10 months, depending upon how aggressive the Fed wants to be in bringing down those asset purchases. Remember, to still be buying even while it's reducing the amount it buys. And as Courtney said a few minutes ago on Closing Bell, we did talk to Boston Fed President Eric Rosengren. Here are some of the direct headlines. He said with another strong jobs report, he would support the September taper announcement, and he would want to finish the taper mid-year 2022. So that's about an 8 to 10 month time frame there. The criteria for raising rates, he said, is different for a taper, but he did say that if wages continue to rise faster than expected, that might be a reason for raising rates. Now, just to be clear, no decision been made yet by the Federal Market Committee. Committee could delay the announcement until November if that August jobs report is weak, the Delta variant sparks a new round of economic lockdowns, or inflation readings ease off. Fed Chair Jay Powell, he's yet to speak since that July jobs report came in hotter than the Street had expected, and producer prices came in at double the consensus. So the focus now turns to Jay Powell in Jackson Hole, where he could set the table for that September announcement. Courtney?
Very interesting timing, of course, Steve, for that big Jackson Hole conference. I just have to ask you, if Rosengren says taper could start in September if there's another strong jobs report, can you remind us where the economists are right now with what they believe is going to happen when the extended unemployment benefits roll off for more Americans as it pertains to how it will be relayed in the jobs report?
Okay, but first what I'm going to do when I'm answering this question is I'm going to look up, which I have not looked up yet, the consensus for that August jobs report, for the August jobs report. It's a little early days yet, so we may not have it. But right now, the expectation is that sometime in September, these extended unemployment benefits will roll off. And the result of that is that some people who have been, say, sitting on the sidelines waiting to get a job could come back into the workforce as a result of that, and that could ease some of the labor shortage we've had out there. The result of that would be to ease some of the wage pressure in the economy and thereby easing some of the inflationary pressure. That's the kind of stages that people expect, forecasters expect the economy to go through as part of the idea that the inflation surge we have will be temporary.
Steve, it's Karen. Let me ask you something. It seems like there's been sort of a concerted effort among members of the Fed to sort of get this message out there, get the market ready. The temporary tapering is coming. Do you think the market is accepting it? I mean, because it hasn't been that huge of a reaction, certainly versus the last time we saw this. Or are they questioning whether, maybe the Delta variant causes, less more pressure, economic pressure? What do you make of it?
I think there's a bunch of explanations. I think that's a really good question, and I'm actually working on a story about why this has been taper tranquility so far. I'm not sure if that's the right word, but there's a couple answers out there, Karen. Let me start with the idea that Fed Chair Jay Powell has been extremely focused on making sure there wouldn't be a tantrum, and he has studied what happened in 2013, and he believes the answer has been advance notice. I think he wants to lull you to sleep by this. Remember, we started talking about a taper, in the spring. By June, we had a pretty detailed report about the Fed's plan to roll this out. And then they began rolling it out. So they talked about it at the June meeting. They talked about it at the July meeting. They're probably going to talk about it in Jackson Hole. September, they'll do it. And let's not forget this, Karen. We're talking about a taper. What does that mean? A reduction in the amount of purchases. So what I calculated today, Karen, and you can double check me on the math, if you take 120 billion down by $15 billion a month over 8 months, you are still going to add 660 billion to the balance sheet while you're tapering. So that's sort of a non-event, I think, for markets that believe that we're going to have pretty strong growth, and they probably bought into this idea of inflation being temporary.
Hey, Steve, it's Tim. How about the concept of, look, the Fed really needs to wait to see September data because the world's, at least our kids back in school, country seems to be really coming back on, people coming back from wherever. Does that change the timeline for you? Because ultimately, I think September data means, out in October means they can't do anything till November. That's my logic.
All my reporting is conditional upon the August report being strong. But I think, Tim, where we are right now is that the August jobs report has to prove why the Fed should not announce the taper. And that's a bit of a change, right? I think, as a result of that, you'd have to have a really strong report. But if it was the other way, but I think the way we are now is if that report comes in 500,000, 600,000, I think that's good enough. If it comes in 700,000 or 800,000, definitely good enough. Down in the 200,000 or 300,000 range, maybe they wait a little bit.
Steve, thank you very much for being here with us and for answering all of our questions that, of course, don't have any real concrete answers, as we're all just waiting to see what happens. Have a great night.
And Courtney, just for the record, Courtney, I don't have a non-farm payroll estimate yet from Reuters. It's a little early yet.
So I really threw you a trick question, and I'm sorry about that.
It's not something I didn't know. It's something I didn't have the answer to. So there you go.
Fair enough. Fair enough. Thanks, Steve. Have a great night. All right, let's trade on this a little. Mr. Adami, we have not heard from you yet. What do you make of all of this and the Fed's timeline right now and what Mr. Rosengren had to say on the closing bell with Steve?
Yeah, it's interesting. It's starting to line up with a lot of voices out there, the September-October notion. And I think Karen's question was spot on. Why is not the market reacting to this? And I think Steve's answer was also spot on. The fact that, although maybe we're talking about a $15 billion a month thereabouts, we're still talking about a Fed that's going to continue to add to their balance sheet. One thing that concerned me, and it's a question for another time, is the bond volatility we're seeing. I talk about it a lot. I'm becoming a bit of a broken record, but the moves in 10-year yields are extraordinary, in my opinion, given it should be the most liquid asset on the planet. You've seen it. I don't need to go back and tell you some of the moves we've seen over the last few months, but they're remarkable. And maybe the market's just become accustomed to it, but I would submit that bond volatility is typically the precursor of equity volatility, and that's what my concern would be.
Nadine, what's your thoughts here?
Well, we looked at it a little bit differently, and that is, yields just trade in a range. And so we were long fixed income and some treasuries last week, and then you get yields down, so the bonds are up, and then today is the day that you trim them. If you're feeling a little bit more lucky, maybe you go short the TLT. But we're just seeing it trade in a range. So that's what we've been doing for client portfolios. And what we're looking at in terms of the data for GDP is that it's decelerating around the world. So the growth is decelerating. So we actually think that the Fed's going to have to walk a fine line between some of the positive numbers, so labor coming back in the market, inflation being high, and then also looking out to say, okay, if things are going to decelerate, how do we walk this fine line?
So, Tim, if the market is sort of unreactive right now to some of these taper headlines, does that mean that rates are going to matter more? Do they matter less as we're battling inflation? Are we all just finally ready to get out of this period of unprecedented rates?
Yeah, I hear you. I don't think the markets are even close to ready to get. I mean, so if you think about it from the market's perspective, I think the sense of when the Fed and I don't want to speak for other folks. The sense that the Fed is going to raise rates anytime soon is not in the market, nor should it be, because the Fed has been very clear on telegraphing this. When central banks are truly pulling in liquidity, and when the Fed is the beginning of global central banks pulling in liquidity, I say get out of the way. And what we've just said now, and what Steve underscored, is that the Fed's balance sheet will actually be growing as they are tapering. I think that the market also tends to get ahead of the Fed. So if the Fed is actually beginning to pull in at least some of its accommodation, things like the 10-year, to me, begin to price in maybe a little less liquidity, maybe a little less growth. And what's concerning to me as an investor is that things like the inflation, whether it's PPI, CPI, whether it's the inflation components of that University of Michigan confidence number, which was not that great relative to where you see all this other. Like, we should see rates higher. And ultimately, I think we are getting a little bit of a message from the market. And I think the minute the Fed begins to assert themselves, I think rates are in long end are going to move lower because I think the sense is they're going to think one step ahead of what's actually happening, even though, yes, intuitively, rates should be moving higher. But I think we got a chance to see this 3 months ago when the Fed began to start to guide this conversation.
Right. And Karen, sort of to your question to Steve, in the same vein, why don't you think the markets are reacting more to some of these taper headlines? Because they've been so communicative to the market?
I think that's part of it. I mean, the market has been concerned about inflation for a long time now, and there has been this big debate whether it's transitory or not, and it seemed transitory somewhat, but then you get these big employment numbers. So that's an argument for the other side. I don't know. It might just be that the absolute interest rates are so low that does it really matter if they move a little? I'm not quite sure. I really don't know.
Karen, I mean, you are so smart, and I love that you say that because, Nadine, I always say, like, rates are so low. If they raise them 50 basis points, does it really matter that much? Like, am I not understanding this well enough?
Well, I think that the points about being 2 steps ahead by Tim was really important here. And that is, if you look historically, when there's tapering post-QE, markets actually tend to go up. And so that might be a little bit counterintuitive, but people are playing a few steps ahead. And so when we look at the market today, it actually makes sense to us. But what we think about the rates is that it'll probably be range bound for a while. So again, we think of just trading in a range. We don't think it's jumping of like the 10-year above 2. It's not going below 1. But you have this sweet spot range it's trading in. And then you can't, therefore, go all in one way or a different way at any one time, but you can trade around it.
I'm going to give you the final word, Guy, before we wrap up this conversation.
Yeah, I'm not an economist. I say it all the time. I'm not smart enough, nor am I humorless enough to be one. But what I will say is, I do think bond volatility is a thing. And to your point about, 50, I mean, I know this is just math, but listen, 50 basis points when 10-year yields are 10% are one thing. When they're, 1.3%, it's entirely different. So I think we all understand that. I'll just say, finally, Fed has done a masterful job, whether I like it or not. I mean, they've done a masterful job in communication vis-a-vis the fact that the volatility, the VIX is 16.5, 17, and the market continues to make all-time highs. Under that mandate, they've done an incredible job.